In this video, we will be talking about common mistakes as they relate to the financial requirement. In part 1, we'll discuss mistakes relevant to those of who are including employment income from non-specified limited companies towards the financial requirement. If this terminology is unfamiliar to you, hopefully this will soon become clear. And in part 2 of this video, we'll discuss mistakes relevant to those of who are including specified limited company income. Part 1, employment income from non-specified limited companies. The first mistake that we have to start with is not correctly identifying whether a company is a specified limited company or whether it's a non-specified limited company. And if you've already watched our 1 hour plus long spouse visa requirements and process video, in this video we will be discussing this in more depth, as we will identify numerous situations in which partners wrongly identify the type of income they want to include. Knowing whether the employer is a specified limited company or not is incredibly important to know, as if you get this wrong, a likely outcome is a refused application, as pretty much everything about the financial requirement is different. The relevant financial period is different, the calculation of employment income is completely different, and the required financial documentation that you will have to submit is also different. The first thing to note is that a limited company and a specified limited company are not necessarily the same thing. This is because a specified limited company is a concept that is specifically defined in the immigration rules. The majority of employers are going to be limited companies. For example, Tesco's and Goldman Sachs are limited companies, but they will never be specified limited companies. And the reason for this is because the employer is a specified limited company if all of the following apply. 1. The company which provides an income being relied on is a limited company registered in the UK, and the person whose income you are relying on is either a director or employee of the company, or both, or of another company within the same group, and shares are held either directly or indirectly by the applicant, sponsor, or by family members of the applicant or sponsor. Family is defined here in the immigration rules to include parents, grandparents, children, stepchildren, grandchildren, brothers, sisters, uncles, aunts, nephews, nieces, or first cousins. And then finally, any remaining shares are held, either directly or indirectly, by fewer than 5 other persons. It is this aspect which means that large employers like Tesco's and Goldman Sachs will not be specified limited companies. So if all of the above 4 apply, the employing company will technically be a specified limited company. On the other hand, if one of the above does not apply, for instance the remaining shares are not held by fewer than 5 other persons, the employing company will not technically be a specified limited company. I say technically here because, as we'll discuss shortly, there are some situations where Home Office caseworkers may incorrectly treat an employer to be a specified limited company, even if the company does not strictly fall in the above definition. Since this is such an important distinction, let's break this down. 1. Specified limited companies are technically only UK limited companies that are registered in the UK. If the company is registered outside the UK, the immigration rules states that it will not be a specified limited company, regardless of whether shares are held or not. 2. The person whose income you are relying on must be either a director or employee of the company that provides them with an income. It is often the case that limited company business owners would ordinarily regard themselves as being self-employed. But it is important to note here that the immigration rules specifically define a self-employed person as those who are sole traders, partners, or are in a franchise. Therefore, if a business owner owns a limited company and receives salary or dividends, they will not be treated as being self-employed in the immigration rules, despite the online application form describing it as such, which is another misleading aspect of the online application form. We've also seen that some partners have some difficulty identifying whether they are employed or self-employed. Since this completely changes the requirements that apply, this is important to identify. The first thing to note here is that if you want to include the income as employment income, the person's employment status will need to be confirmed by the employer. This means that, in reality, if the person is self-employed, the majority of employers will be very reluctant to say that they are in fact an employee, because employees have much more rights than those who are self-employed. Furthermore, this table here discusses the difference between those who are employed and those who are self-employed. Feel free to pause the video to read these in detail, But in summary, those who are self-employed tend to have much more freedom with regards to how they spend their time. Whilst employees are not only normally paid through PAYE, which is the pay-as-you-earn scheme, they must also act in accordance with the agreement in place between them and their employer. If, at this stage, you're still unsure whether the relevant person is employed or self-employed, I'd suggest contacting HMRC. The third requirement that must be met in order for the company to be a specified limited company is that the shares must be held either directly or indirectly by the applicant and or sponsor and or family members of the applicant and or sponsor. If shares are held of the company can be a specified limited company, as long as all of the other aspects are met. If shares are not held of the company, either directly or indirectly, the company cannot be a specified limited company. The immigration rules here contain the words directly or indirectly. An example of shares being held indirectly is where a person does not hold the shares on paper, but, based on the documentation and information provided, it appears that they benefit from the profits of the company as if they were a shareholder. For example, let's say a sponsor owns 100% of the company. They then look at the specified limited company documentation and think, it's just too much to submit, so let's circumnavigate the rules. I'll give my shares to a friend, but I'll still primarily benefit from the company's profits because my friend will then send me the money that they receive from the company. So here, since they gave the company shares to a friend, they will not be directly holding the shares, but it very well may be the case that the Home Office caseworker would consider them to be indirectly holding the shares here. The final requirement is that any remaining shares of the employing company are held, directly or indirectly, by fewer than 5 other remaining persons. So let's explain this using an example. A limited company's shares are held by 3 persons in total. 1, the sponsor, 2, a non-relative, and 3, a non-relative. In this example, the other remaining shares are held by 2 persons. This is because we will not include the sponsor here. So, as we've mentioned, there are certain situations where Home Office caseworkers go beyond this and incorrectly treat companies to be specified limited companies, and even when it goes against the published Home Office guidance and immigration rules. Not only is applying the specified limited company's definition not always obvious, depending on the particular application, this can be an area which is relatively complex. We will now discuss 3 instances which will normally warrant careful attention from an experienced immigration advisor. The first situation is when all of the aspects of the specified limited company definition are met, except for the fact that the company is registered outside the UK. So we had a client recently who, when he first approached us, he told us that his unmarried partner visa application for his partner was refused. The sponsor was a director and shareholder of a company. There were fewer than 5 other shareholders. However, the company was registered outside the UK, in Malaysia. The company had no ties to the UK, and as previously discussed, the immigration rule states that only companies registered in the UK are specified limited companies. So their application was refused, and in the refusal letter, it stated that the specified limited company documents were required. So in our initial consultation, we reviewed the application that him and his wife previously submitted, as well as we had a deep look at their particular circumstances. Technically, they provided the correct supporting documents, and their application met all of the mandatory financial immigration rules. However, despite this, the Home Office caseworker that dealt with their application wrongly applied the immigration rules. After discussing their options going forward, they decided for us to represent them, and we approached this by presenting the correct information in the most meticulously clear way possible. And the applicant and their child joined the sponsor in the UK 7 weeks later. The second situation where a greater degree of caution is warranted is when the employer is a self-employed family member. Specified limited companies are only limited companies. Therefore, when the employer is a self-employed sole trader, the employing company cannot be a specified limited company because self-employed sole traders are not limited companies by definition. Furthermore, it would not technically be possible for self-employed persons to provide the specified limited company documentation, as they are completely different. The last situation, which results in a risk of companies incorrectly being treated as specified limited companies, is where there are more than 4 other persons that hold the shares of the company, but the applicant, sponsor, or family members is a majority shareholder. This is a screenshot of a confirmation statement from a client of ours. Confirmation statements are publicly available documentation which can be found on the Companies House website, which sometimes lists the name of the shareholders and their corresponding holdings in the company. Home Office caseworkers often check this document and the company's house profile of the company to check whether the company is a non-specified limited company or not. This document shows that the sponsor and a family member of the sponsor hold shares, and there are 8 other remaining shareholders. Therefore, if the immigration rules are read literally, the company will not be a specified limited company because there are more than 4 other persons that hold the remaining shares. However, as you can see here, the sponsor and the sponsor's family member hold a majority of the shares. If you total the sponsor's 1,875 shares with the family member's 219 shares, this equates to more than 2/3 of the total shares. The reason why they may consider the company to be a specified limited company here is because, and to quote the Home Office guidance, where the company is in sole or limited family ownership, there is scope for doubt as to the effective control of the company. The second mistake that we will now discuss is the employer's letter not stating the period over which they have been or were paid the level of salary relied on in the application. This is a requirement which only applies to non-specified limited companies. This mandatory requirement is an example of the immigration rules requiring something which would not ordinarily be complied with, as it is a relatively unintuitive requirement. This is because the employer's letter needs to state not only the gross annual salary that was received on the date of application, but the gross annual salary specifically for the relevant period that you're relying on. The vast majority of employers are going to be unaware of the relevant financial period for Category A and Category B applications, and following from this, they are unlikely going to specifically state the salary for the period that is being relied on in the application. For example, most commonly, an employer's letter would state something along the format of Vitalik Buterin currently receives a gross annual salary of £20,000. This does not comply with the immigration rules as it only states the current gross annual salary. It does not state the gross annual salary for the relevant period relied on, which is the 6 months prior to the date of application under Category A, and employment held up to a period of 12 months prior to the date of application under Category B, and is one of the many examples of the tiny minutiae of the immigration rules which the Home Office caseworker can technically refuse the application on, should they decide to do so. Example 2. In the last 6 months, Michael Saylor received a gross annual salary of £30,000. Michael's employer has got the correct approach here because, unlike example 1, this states not only the current gross annual salary, but it also states the level of salary received for the relevant period relied on, assuming Michael wants to rely on Category A, where the relevant period is 6 months. Example 3. Satoshi Nakamoto currently receives a gross annual salary of £210,000. They started to receive this salary on 1st of September 2022. Prior to this, Satoshi received a gross annual salary of £170,000 between 1st of August 2021 and 31st of August 2022. Unlike the previous 2 examples, Satoshi's salary varied here, and therefore he was correct to state not only the current salary, but also the level of salary relied on throughout the relevant financial period. The next commonly made mistake that we will discuss is combining cash savings with Part 2 of the 2-part Category B test. We discussed the calculation of employment income under Category B on our spouse visa financial requirements article on our website, but in short, there are 2 tests that must be satisfied. The first test is that the employee's current gross annual income from employment must satisfy the minimum income threshold of £18,600, higher if dependent children are also applying for a visa. Cash savings can be combined here to satisfy the first test. The second test is that the employee must have received employment income which meets or satisfies the minimum income threshold of £18,600 in the 12 months prior to submitting the application. Cash savings, however, cannot be combined to satisfy Part 2 of the test. Let's use the example of Sarah, who wants to combine her cash savings, which equates to a gross annual income of £15,000, with her employment income to satisfy the financial requirement. Sarah's current gross annual income from employment is £12,000. Since cash savings can be combined with employment income here, Test 1 is satisfied. £12,000 from employment, when combined with the gross annual equivalent of £15,000 from cash savings, satisfies the minimum income threshold of £18,600. Okay, so test 2. Sarah has been employed for 4 months. She has received a total of £4,000 in employment income in the 12 months prior to submitting the online application. Unfortunately for Sarah, the £15,000 equivalent annual income from cash savings cannot be combined with the £4,000 in employment income to satisfy this second test. She therefore does not meet the financial requirement under Category B. So what should fictitious Sarah do? Well, the most obvious thing here would be to wait until she is employed for 6 months when she submits the online application. This would allow her to apply under Category A, and this is because under Category A, due to the way in which it's calculated, the financial requirement will be satisfied when you combine the employment income and the cash savings. The second half of this video is specifically aimed at those who want to include specified limited company income under Category F or G. Therefore, if you're sure that you are not including specified limited income under Category F or G, if you have not already, I would recommend watching our spouse visa requirements and process YouTube video, as I'm very certain that it's by far the most comprehensive spouse and partner visa video guide on the internet. A commonly made mistake by partners who rely on specified limited company income is that they don't identify the relevant financial period. This is important because 1. The documents must reflect this period, and 2. The calculation will be based on this period. The relevant financial period for specified limited company income will be the specified limited company's most recent full financial year, and this can be broken down into 2 aspects. 1. The company's full financial year, and 2. The relevant financial year is the most recent full financial year. The company's full financial year will be as specified in the specified limited company's CT600 company tax return document. If you do not have access to the CT600 document already, you should ask the company's accountant for this. And, as a side note, if the company does not have an accountant, in all likelihood the company will need to get one in order to satisfy the requirement to provide an accountant's certificate of confirmation. On the first page of the CT600 document, you will see a from and a to date, such as in the screenshot here. In this example, the company's full financial year starts on 1st of April 2019 and ends on 31st of March 2020. Aspect number 2. The relevant financial period is the company's most recent full financial year that passed. Using the same example, the fact that this CT600 period ends on 31st of March 2020 is significant, as this will not be the most recent full financial year that passed. Rather, the company's most recent full financial year, if you're watching this video before 1st of April 2023, will be 1st of April 2021 to 31st of March 2022. Therefore, it's important to identify the relevant period early on, as this will allow you to identify whether new accounts have to be filed prior to submitting the online application. There is, however, one exception to the financial year having to be the most recent, and this exemption relates to fiancé or proposed civil partnership visa to FLRM applications. In other words, when an applicant has been granted a fiancé or proposed civil partnership visa, and they then submit an FLRM application, aka an in-country spouse visa application after marrying but prior to their current fiancé or proposed civil partnership visa expiring, there is an exception to the financial year having to be the most recent rule. In this specific case, these applications are permitted to rely on the same financial year as the fiancé or proposed civil partnership visa application, as long as the specified limited company's income was relied on in the fiancé or proposed civil partnership visa application, and the FLRM application is submitted prior to the fiancé or proposed civil partnership visa expiring. The next commonly made mistake is a result of not knowing what specified limited company income can be included towards the financial requirement. There are 2 types of income that can be included towards the financial requirement from specified limited companies. 1. Employment income, and 2. Dividend income. So the reason why we decided to highlight this is because not only have we seen that accountants like to use their own accounting terms, such as drawings, but also it's the accountant's job to sometimes be creative and label income as something other than employment or dividend income. Most notably, retained profits and repayment of a director's loan are not technically includable towards the financial requirement, as they are neither employment income or dividends. Therefore, in light of this, not only do you have to make it clear in your application as to the amount of employment and/or dividend income received, but you also have to make it clear to your accountant how much income it is that you need to evidence in the form of employment or dividends. Nothing else is relevant. Furthermore, not only do you want to make this clear to your accountant, you want to make this clear early on in the process, before the accountant files the accounts. The next mistake that we will discuss is not knowing that dividend income can sometimes be declared after the full financial year. So this does not necessarily cause refusals, but not knowing this can sometimes cause partners to incorrectly think that they cannot satisfy the financial requirement. The reason for this is because in the immigration rules, as they discuss dividend vouchers, this goes against the standard approach that the relevant source of income must be received in the relevant financial period. In order to evidence dividends, the immigration rules require dividend vouchers for all dividends declared in favour of the person during or in respect of the period covered by the company tax return CT600, showing the company's and the person's details with the person's net dividend amount. Therefore, it's perfectly fine for a dividend to be declared after the end of the most recent full financial year, but still be includable towards the financial requirement, as long as the dividend is received into the person's account prior to the online application being submitted, and also assuming that the accountant is able and willing to do this. For example, the CT600 tax return period is 31st of January to 1st of February. On 5th of February, Bob realises that he is £4,000 short of £18,600. Bob can therefore declare £4,000 plus in dividends, receive the £4,000 plus in dividends, and then submit the online application, as long as the accountant is able and willing. The next mistake that we will discuss relates to specified limited companies that do not have a 12-month full financial year. The Home Office guidance specifically states that the relevant financial year here should be a 12-month period. This is important to note because it is often the case that limited companies in their first year change their accounting period to be either fewer or longer than 12 months. Therefore, if you're relying on income from a specified limited company which has not yet submitted its first year accounts, please speak with the company's accountant as soon as possible and highlight the importance of the financial year being 12 months. If you do not point this out, it is likely for the financial period to be either fewer or longer than 12 months, assumedly because the accountant has the flexibility to choose as they wish in order to minimize tax liability. As to how a non-12-month financial period would affect the chances of a successful application, there are two main factors. The first factor is whether the financial year is fewer or longer than 12 months. This is less likely going to be an issue if the most recent full financial year is fewer than 12 months, and more likely going to be an issue if the most recent full financial year is longer than 12 months, as the latter may arguably unfairly benefit the application as you're using a bigger time frame to count the includable income. And the second factor, and the most significant one, is who your particular Home Office caseworker is going to be that deals with your application. Obviously, some Home Office caseworkers are going to be more knowledgeable or lenient than others. Now, one thing worth noting here is that some of our clients' accountants have managed to change the financial year from a non-12-month financial year to a 12-month financial year. As to whether this is in practice something that's permitted in the relevant accounting rules, as we're not accountants, we're not really able to say. So if you're in this position of the relevant specified limited company's financial year not being 12 months, the best person to ask will be the company's accountant. The second to last mistake relates to the relevant period for the other sources of income when combined with specified limited company income. So we have discussed that the relevant financial year for including the specified limited company income is the most recent full financial year for category F. But it is important to note that if you combine specified limited company income with other sources of income, the relevant financial period for the other source of income generally changes to match the same period as the specified limited company income. For example, this is a table showing the amount of specified limited company income received. The numbers 13 to 1 here relate to the number of months prior to submitting the online application. The months 13 up until 2 are highlighted in orange because that is the specified limited company's most recent full financial year, and thus the amount that can be included towards the financial requirement. Month 1 here will be irrelevant with regards to the amount that can be included towards the financial requirement, as it is outside the most recent full financial year. So if we total up months 13 to 2 here, this will mean that £15,000 specified limited company income can be included towards the financial requirement. For non-specified limited companies, under category A, the relevant period will generally be the 6 months prior to submitting the online application, and for category B, the relevant period will generally be the 12 months prior to submitting the online application. However, When you combine specified limited company income with non-specified limited company income, in this example, it will only be months 13 to 2, i.e. the relevant period for the specified limited company income, which are relevant when determining the amount of non-specified limited company income that can be included towards the financial requirement. And this is because when you combine specified limited company income with other sources of income, the general rule is that the relevant period changes to match the specified limited company's relevant period. In addition to this, it is also important to note that when you combine specified limited company income with other sources of income, in addition to the other source of income's relevant period changing, there is also a requirement for the other source of income to still be a source of income when the online application is submitted. Continuing with the example of combining specified limited company income with non-specified limited company income, here you can see that the non-specified limited company income stopped becoming a source of income 4 months prior to submitting the online application. Therefore, in this instance, as the non-specified limited company employment income is not being received when the online application intends to be submitted, the amount of non-specified limited company income that can be included towards the financial requirement is £0. Since the specified limited company income alone in months 13 to 2, i.e. the relevant financial period, totals to £15,000, the minimum income here is not met. And the last mistake that we will discuss is trying to combine cash savings with specified limited company income. And the reason why this is a mistake is that cash savings cannot be combined with specified limited company income. For example, Peter's specified limited company income, comprising of employment and dividends, is £15,000. He has cash savings which equate to approximately £15,000. And finally, he has property rental income of £15,000. In order to meet the minimum income threshold of £18,600, Peter will have to combine either specified limited company income with property rental income, or cash savings with property rental income. And this is because employment and dividend income under category F here cannot be combined with the cash savings. In such a case, Peter would ordinarily be advised to rely on cash savings under category D with property rental income under category C. And this is because cash savings are ordinarily easier to evidence than specified limited company income. So that is it for this video. I hope you found it helpful. In the next video that will be sent out, we will discuss more commonly made mistakes, including a couple online application form questions, the translation of documentation, and the sole parental responsibility requirement. And if you have not already, you may want to watch our 1 hour plus incredibly in-depth spouse visa requirements and process YouTube video.